All right, everybody, I'm Josh, and this is,
Lake Baxter.
and we're here giving you some detailed fundamental market insight here on the natural gas industry, coming to you not live, but on a video from Brooklyn, Wisconsin. You're outside here enjoying the nice fresh air while our wives and kids are, my kids anyway, are out for a walk around the lake. So
Yeah, the new BEE location out here in the country with plenty of breeze and sunshine.
amen to that. So
In fact, the Dutch have now advised that people could start like forming social spheres where they interconnect with each other, a limited of maybe 10 people. So, I mean, we're basically experimenting with that. My wife and I haven't been out shopping for over a week. And, we've been wearing masks and gloves when we go out. And I hope that Josh and Jenny have been doing something similar.
we've been doing our part.
So, we think the probability for us is low. So we're back to bringing you a weekly video.
Yeah, here we go. Well, let's jump into it. So right now, we've got a lot of turmoil going on. We got COVID-19. We've got negative oil prices. Yet we're in the natural gas industry. What's the correlation there? Is there any correlation? What's going on with this negative pricing?
Well, I think that's been probably the number one question. Everyone saw the news articles about oil going negative. With nobody on the highway and industry cut way back, demand has absolutely plummeted. So the oil storage fields are getting near max capacity. And when there's no place for a product to go, it went negative. Surprise, surprise.
Right.
People have asked, though, what does that mean for natural gas? Well, interesting enough, it's kind of an inverted relationship. Gas front month, gas today, is relatively cheap, $1.80, $1.90, because we're seeing the same thing. A lot of industries cut back, demand has gone down, so prices have gone down. But on the other hand, there's a narrative in the marketplace that says that with oil now being uneconomic in the U.S., especially the shale oil fields, that you're going to see a sharp drop in natural gas before winter. And so where you have low prices right now for natural gas, you're actually seeing January of next year trading over $3. Well, there's a few issues with that narrative. Number one of which is that people have kind of gotten wrapped around this associated production. I mean, natural gas comes out of the ground either in a wet state with oil or natural gas liquids, or it comes out dry. And actually, 80% of U.S. production comes from fields that generate dry natural gas production. So when you talk about the threat of low oil prices to gas, you're talking about maybe 20%. Now, that is significant, but there are factors that come to mitigate that, in my view.
Okay. So the great majority of gas is coming from these dry wells. So it's decoupled, if you will, from the petroleum industry.
That's correct.
But another factor would be, don't we ship a lot of LNG overseas?
Well,
or is something happening with that?
Well, hold that thought.
Okay.
Because, let's talk about dry gas again just for a moment. Dry gas, a lot of these dry gas drillers in these shale fields have exploration costs of around $1.50. So actually what we're seeing right now is because of this fear about the loss of associated gas, winter gas over $3 is incredibly economic for the dry gas shale drillers. So, while we couldn't see a drop of gas production from the oil plays, we're liable to see an uptick in gas production from the dry fields. Now, this is where the coronavirus plays into this whole mess, because the question is, with a lot of energy companies, period, suffering through the COVID-19 crisis, will they have the capital to really get drilling back into gear? So, I mean, this thing kind of wraps around itself in a number of different ways.
Mm-hmm. So if you're talking to clients, obviously, right now, and they're probably wondering, well, $3 gas for next winter seems somewhat attractive, though this year a lot of people locked in $2.60 for decatherm. I mean, what would you say for folks that might be itchy to do something for next winter? What's your take on this?
Well, I mean, our position has always been, if you are extremely sensitive to gas price and you're concerned about the possibility of extreme gas prices, you can always hedge some portion of your gas requirement. That's not my advice at the moment, but it's certainly an acceptable business strategy to say, hey, right now, if you look at a 5-month strip, you're talking about gas in the 290s. Historically, that's still comparatively cheap, but I still think it's a little bit overbaked right now. Another thing that's driving the market right now is kind of our continued cool spring. In fact, if you look at the weather forecast this week, they're showing New England as being much below normal for the next week and a half. And right now, that trend looks like it's going to continue. And if you look at the storage data, what we're seeing is that the storage fields in the Northeast, which field at a pretty good clip during this phase last year, are barely injecting because that gas is still being used in the residential market. So the continued cool spring is kind of masking how much gas is out there right now. Now, to your question earlier, LNG. Now, LNG is an interesting proposition also, because right now the U.S. Was basically exporting 10 billion cubic feet a day of natural gas. Those contracts require companies receiving that gas in Europe and in Asia to provide 60 days advance notice of canceling shipments. Well, for the first time now, we're actually seeing shipments getting canceled. Right now, we've seen 25 shipments at least get canceled for June. Each of those ships is roughly equivalent to about 3.5 billion cubic feet. So 25 at 3.5. So in June, we're going to see about 3 billion cubic feet, at least 3 billion cubic feet of gas back up into the U.S. that was going to the export markets. So depending on the weather, we could really see surge in gas inventory come June. Now, there's also a lot of people betting that we're going to have a hot summer, and because gas is cheap, that the power generators are going to gobble up gas this summer. Well, I'm pretty much calling bogus on that too, because if you go back and look at last July and August, gas was actually $2.20 then. $2.20 in a 7,000 heat rate, which is a high efficiency combined cycle, is $15.40 power. Well, that's like half the price of a power generator from coal. So, it was $2.15, $2.20 last July and August. So if it's $1.80,
it won't matter.
It's not going to matter. I mean, Can you be more in the money? I mean, gas is already in the money. So gas prices have gone down, but it really doesn't change the economics. And then if you look at it, look at the numbers, most of the generation being added this year is renewable generation. Most of the coal fleet that's going to be retired has been retired. And there will be a few more gas plants come on this year, but primarily what's coming on are renewables. And effectively, renewables displace natural gas in a number of power markets now, especially Texas and California. So, unless we have a scorcher of a summer, I don't see this year's low gas prices producing a much different result than last year's low gas prices.
So the people that say we're going to have a scorcher of a summer also told us we're going to have one hell of a winter this last year.
There you go.
Which never happened.
Even recently, it's like, I keep seeing forecasts saying we're warming up, but we keep dipping back down here. The forecasters are kind of struggling right now.
Okay. So for the sake of time, let's shift gears and end on one topic. So we just finished up all of the RFPs.
Yes.
So how do you summarize how that went, how the pricing went, given everything in the WEC tariff that we've kind of endured? Where do you feel about how this all settled?
Well,
in 10 seconds. No, just kidding.
We still saw a fairly good level of competition this year. The state can use more competition, which is what we argued prolifically in the proceeding. And the new rules don't really encourage new competition. But another issue is that the WEC has struggled to even implement what they got, and when we went out and did a united effort with all of the suppliers and many businesses in Wisconsin, they agreed to postpone implementation until April 1 of 2021. So not going to see the effects this winter. So I'm not confident that that all of the marketers were really including the economics of what is about to happen in their analysis this year. So yeah, we had a good year. It's still pretty tough out west. Prices are high for delivery of gas in the west. We saw some very competitive prices in the east. Some, in fact, were actually lower than what we've seen over the last couple of years. So it's kind of a mixed bag, but I think the jury is still out because implementation of the regulations have been delayed.
Mm-hmm. Okay. Well, yeah, I know when we do all this work too, I mean, we're watching every client, every meter, every month. So we determine what to do, and different clients that are watching this, we've had some frank conversations about even continuing forward. I mean, we don't want to keep you in a program that isn't healthy for them, obviously, and healthy for you guys. So we're looking out for your best interest with good intentions on that whole front. So anything else you want to conclude here?
No, I think I've said a lot. And if you get me talking about another topic, we'll be here another 10 or 15 minutes.
Yeah,
so.
We'll save that for another time.
Yeah.
So, all right, well, thanks for tuning in. I'm Josh. This is Blake, and we'll catch you on the flip side.
Stay healthy, everyone.
Stay healthy.